All right, good afternoon, ladies and gentlemen, and welcome to our Thursday webinar. Remember, this is a series of webinars which are rolled out to you, and we have different topics every Thursday to help you get hold of your trading strategies and even in your risk management. Like today, we're talking about risk management. This is to keep you mentored and to keep on getting better in your trading. So welcome all, and let's start. Make sure that you can hear the audio well, you can see the screen, right? And if you have challenges, maybe check out on your device. Make sure you join in with an audio options to make sure you can hear clearly. Welcome all. In case you have any questions and you want to understand even better, ask the question towards the end. There is a panel on your screen that you should be able to type a question, and we look at them towards the end. I see there are still a few of us who are saying that they're not able to hear. Please make sure that you check out on your audio options and enable the audio so that you can hear. All right. And someone else asking even before we start, where the next beginner class is starting, so that you prepare yourself. Well, for the beginner classes, you can always join them online, right? Webinars on Wednesdays, and also on Fridays we have trading strategies, and even on Saturdays we have like a summary of everything that you're looking at. Even more importantly, you can contact your account manager so that they can send you pre-recorded sessions for you. So let's go back to what we have today, and it's 5 things to get hold of in risk management. All right. Okay, so remember, when you're forming a trading strategy, we say that you check out on, first of all, you choose the financial instruments that you want to be trading on. You've got a couple of financial instruments you might want to speculate on and take advantage of the markets. Well, once you select your financial instrument, the next thing then is to work on your trading strategy. Your strategy will require you to have combined several tools. Maybe you're using support, resistance, or you're looking at the price action. You have your trading strategy there. You know where to enter, where to exit, right? And then maybe you're combining several indicators. That's your trading strategy. But then there's something very important as well, and it's risk management. As you're opening your positions, you need to understand that you are not overexposing yourself to the markets, or you have the risk in control. Remember, every time that you're trading in the markets, that this is a risky, it's a risky market. Just like any other business, you will encounter risk in Forex markets. All right. So what are those things that you must have in your trading strategy to ensure that your risk management is on top? All right. So one of those things is make sure that you know how much are you risking for every single trade that you enter. For every single trade that you enter, how much are you risking? Most of the times we will tell you, or when you're being trained or someone is giving you some education, they will tell you don't risk more than you can afford to lose. So how will you know how much you can afford to lose in every single trade? So you decide the risk per trade. So you're breaking down the risk in such that you're looking at it from the time you're entering a single trade. That's why you begin to limit your risk. So you are advised not to exceed more than 2%, but traders always can try to raise or slightly raise the percentage of what you're risking in every single trade based on your risk appetite. Sometimes risk appetite will depend on someone's age, your objectives when you're trading, the amount of money you have, right? All those things will drive you towards your risk appetite, but the advised percentage risk you should take in every single trade is 2%, right? That is, if, for example, you have $100 account and you're taking 2% risk for every single trade, it means 2 out of 100, right? If I can maybe do it here, 2 out of 100, then that's one multiplied by your account amount, which is $100. It will give you a $2 risk. So which means that when you place your trade at the level where your stop loss is, if the trade doesn't go your way and you're making a loss at the stop loss level, you should never lose more than $2. That is the 2% risk that you're exposing yourself to. If, for example, you're taking a 5% risk for someone who's got a higher risk appetite, 5% risk For the same $100 account, it means it is 5 out of 100, right? Multiplied by your account value, which is $100. Then you find yourself the maximum you should be risking in every single trade is $5. That one goes on for whichever amount you have and whichever risk percentage you're taking for every account. So at the stop loss level, the maximum allowable loss should not exceed the percentage risk that you've chosen to expose yourself to. So as a trader, you need to decide something also called drawdown. Drawdown is on our next slide. Drawdown is the amount of money that you should allow yourself to lose for you to start reconsidering working again on your trading strategy. Remember, there's nothing which is 100% sure in the markets, right? Even your trading strategy, you won't get 100% profitability out of a trading strategy, right? That's quite rare. So most of the times traders will keep on readjusting and adding a few components, trying to change on how they're approaching things, because the market moves in cycles. There are times when you have one currency trading so much or one currency pair trading so much. After some time again, you have the currency weak, right? It's no longer trading, right? Or we have circumstances changing, for example, right? Risk on to risk off, and there are different financial instruments that you'll have to trade on based on different cycles that you are in the market. And those are the things that will require you as a trader to try and readjust or try to check out on your trading strategy. And one of the things that will force you or make you to try to readjust your trading strategy is the losses that you're suffering. Otherwise, if you're getting profits with your trading strategy, irrespective of the trading cycle that you are in, then of course there's no reason to. But of course, because you have to keep on getting better and making your trading strategy even better, you have to check out on how you have to improve it. So as a trader, even as you figure out how much you're risking per trade, you also need to have a plan on how much should you allow yourself to lose. Let's say, for example, you enter the first trade, maybe you're entering 5 trades in a single day, right? And the first trade you lose $5. Let's say, for example, it's the way you're exposing yourself to $5 risk in every single trade. You lose $5. Next one again, you lose another $5. Next time, another $5. Will you keep entering trades and keep losing $5 every now and then, right? So long as the market is open, because this market is open for 24 hours a day for 5 days a week. Will you keep on losing every now and then, and you're still not stopping trading? You're keeping on chasing the markets to at least recover the profits? Well, you need to have a red line where you have to specify how much drawdown do you get. Sometimes traders want to specify drawdown in a day. In a day, for example, in your day of trading, how much loss should you experience for you to stop trading and call it well, a tricky day, or maybe where you're not able to, it's not quite clear for you, and then leave to fight another day, leave to trade another day. So we have traders who want to consider it. You have a drawdown in a single day. There are others who want to have a drawdown over your trading period, for example, like 1 month, or maybe depending on how much you're drawing. Let's say your trading period. Yeah, I cannot find it well. I'm using a mouse. Your trading period. If your trading period, for example, you deposit $100 and you don't mind how much you lose in a day, for example, but you want to see how you're going to grow your account maybe within 1 month, right? So traders want to have how much will you allow yourself to lose before you start rethinking your trading strategy. So you need to decide how much capital, that is how much capital drawdown you need to allow before you stop and reassess your strategy, because sometimes that's very necessary. So the quick question you need to ask yourself is, will you be willing to lose all of your trading capital? That is what in the markets you hear of blowing an account, right? Or maybe some getting stopped out. Okay, so will you wait up until all your money is like depleted or you've lost everything so that you start all over on your trading strategy? In that case, then it means that you have lost all your capital and you have nothing else to trade. You have to add some more money. Or will you allow yourself to lose 25%? So giving an example of like $100, what this one means is let's talk of $1,000, for example. What this one means is for you to start changing your strategy in case you've been getting losses, yeah, you have to wait up until you lose all your money so that you start checking out on the strategy. You have to start improving it. That's one case. That's what it means for the scenario number one. Number two is it 25%, such that if you do 25% of $1,000, 250, so you find yourself you've lost 250, right? And you're only left with 750. So you've actually lost 25% of your capital, right? Is it is it like a red line for you, so that you have to go back and reinvent your trading strategy and improve so that you can get better, because you've already lost a quarter of your money, you've lost 25% of your money? Is it what you are, is it part of your money management, right? Now, how about someone who is waiting for 50% of the drawdown, right? You want to wait up until if you have $1,000, you lose half of it so that you're left with only $500. That's when you stop trading on that strategy you're using and start working on another one. So this is something also you need to get hold of. You need to decide the maximum drawdown. So like I said, someone will want to say, like for example, in a single day, if I have if I have 3 trades in a day and I've got, if I've lost 3 of them, right? Or maybe in a single day in a single trade I've lost $5, the second one I've lost $5, then you want to stop and wait up until you can trade the next day. Maybe your maximum drawdown in a day is 10. How much percentage is that, for example? See, or maybe is it in your trading period, for example, you've been trading for a few weeks, maybe you've given yourself a target for the month, and then what you've decided for yourself is as much as you're keeping with your risk per day or risk per trade, sorry, how much are you willing to see yourself drawing down your account before you start changing your trading strategy? Again, very important. Okay, so have this in mind. Risk per trade. In every single trade, don't allow yourself to lose more than you are willing to give up in the market for a single trade. Then that one goes to for a single day, for example, your day of trading. That one again takes you to draw down how much is it that you should not allow yourself to lose of your capital. Don't wait up until you lose everything. That's when you start talking of blowing the account, losing all the money. That's when people start saying that forex market is not it's gambling. People start saying forex market is a scam. It's not a scam. It's just because you didn't have a plan on what percentage drawdown do you have to tolerate before you start reinventing your trading strategy. That's number one. We talked of 5 things you need to get hold of. That's number one. Number two, position sizing. All right. So in as much as you are capping the amount of loss as a percentage of your account, then how should you position your trade? How many lots should you trade in every single position which you're entering the market? Position size is all about the lots that you're using in your trades, and lot size is the first tool that you use to control your risk in the market. The first tool, in my honest opinion, I think it's the first tool, because it's what specifies how many contracts, right, you are trading with in the market. And remember, the lot size controls the pip value, right? You use a bigger lot size, then it means that the pip value is bigger. And if the price moves against you by a couple of units, if you have a bigger lot size, it means it will move against you by that amount. But lucky you, if it's moving in your favor and you're getting profit, there'll be more. But for traders, we always know that it is better to consider the risk which you're getting in before you even start considering the profits, right? If you manage the risk, then the profits will come. And that's where the position sizing come in as much as you want to control the risk per trade, then of course that one is going to melt down into the position sizing, or how many lots are you putting in every single trade. How do you try to estimate the position size, your position size? You take the amount of risk which you're taking in the market, and then you divide by the number of stop loss pips times 10, right? That's just a simple way you can use to estimate the amount of lot size you should use. And whichever lot size you find, always make sure that you keep to it, all right? And it will save you. So let's say, for example, the amount of risk that you expect at a stop loss is 100. When I say 100, when I say you expect $100, I mean, for example, if let me share my platform with you, right? That's what I'm looking at. For example, this is my Euro USD on 4 hours. So let's say, for example, I am looking up to this bounce here. I'm just giving an example. I'm not giving out any trade suggestion. I'm just giving out an example. The trade is the pair is trading above the moving averages. Well, and I see it's like this level here, which has been holding as a resistance, it's now becoming a support. Let's say, for example, I want to buy at that point, right? Let's say I want to buy at that point, okay? Then when you're entering your position, remember, you have to know where you're putting your stop loss and your take profit. Let's say, for example, I'll be targeting up here and then have to put my stop loss down here as I will be buying, right? Now, the thing is, what I want to explain to you is, because I said the lot size that you're estimating, you have to know the amount of risk that you're getting into, right? The amount of risk in terms of money. How much is that? That is the distance between, it's the amount of money which you will lose, it's the amount of money that you have specified to risk. If, for example, it is 2%, 2 out of 100, yeah, multiplied by, maybe you have $200 account, that's what it's going to give you, is $4. It's $4, right? So if it's $4, for example, that is your risk amount. That is the amount that you're specifying that if you were to place this trade, for example, buy at this point here, then the distance between your entry, let's say, for example, you enter at that point, or you put a pending order to enter at this point, right? If it were to come down here, or you enter at that point, for example, how much will that, how much in terms of money, will that distance be, right? So the amount of money which you'll be risking, if it's $2 or $4 for that single trade, it's the amount of money which you lose if the trade hits your stop loss, right? That's what you're talking about. So what you're looking up for is you count the number of pips. Let's say, for example, you will buy at that point, just an example, buy at that point. If you put your stop loss just below this moving average, you will have a 50 pips distance. All right, that's 50 pips. If you can see 503, so it's 50 pips. So what you're going to do there, going back to what we are looking at. So your risk amount is $4. The stop loss pips is 50 pips, right? Is 50 pips. So then how are you going to get the lot size? So this one means that it is going to be $4. That is the risk amount. It's $4 divided by the number of pips is 50 pips. That's what multiplied by 10. We are basing this one on a standard lot. That's why we multiply by 10, right? It's going to give you something like it's 4 out of 500. How much is that? How much would that be? Remember, you have put in a very small risk. So if it's $4, then you're going to get a very small lot size because you're trying to squeeze that distance, that 50 pips, to squeeze it such that it just fits $4. And for anyone who has a calc, can help us do that math. It is that is 4 divided by 500, 0.008, right? It's 0.008. So how much is this? You know we don't have a 0.08, but we have a 0.01. So you have to round this one off to 0.01. That is the lot size that you have to put in your trade, all right? And this is the reason why if you have a small amount of money, then you have to take a smaller lot size. this is going to help you to know how much you're going to put out outside there. So say, for example, you had $1,000. If you had $1,000, in this case, this is 4%. This is for 100%. Sorry, for $100 account. This scenario here means that you're risking 4%, right? But if it is $1,000 and you're risking the same 4%, 4 out of 100 is going to give you, multiplied by this one is going to give you, is it $40? Yeah, it will be $40. So you can imagine if you had a larger amount of money, risking the same percentage, right, gives you an opportunity to even have or hold or enter a bigger position in the market, which will be a 0.1. So let's keep to this. And you find traders try to make this mistake. You have got a $100 account and you still want to place a trade of maybe a 0 with a lot size of 0.1, right? Still for the same distance of 50 pips, all right? So what happens when the trade goes against you? Then of course a 0.1 is going to give, for a US dollar pair, a 0.1 is equal to around a pip value of $1. So if you lose those 50 pips, it will be $50, right? But if you kept it to the smaller lot size for the small account, then that's what it's going to result to. A 0.1 pip, a 0.01 pip for a US dollar pair is around 0.1. So 0.1 multiplied by 50 is only $5. So you can see you have a small account of like $100. You're still using a big lot size of a mini lot, right? You will erode your capital a little bit much faster than someone who keeps to this formula of position sizing. You see why it's very important. That's one of the reasons why traders will lose in the market, right? You lose in the market because you're not following a standard way of trying to calculate your position sizes. It's very important. So number 2, make sure you calculate your position size, the amount of lot sizes. Sometimes for the take profit, you might want to estimate your take profit by multiplying the stop loss pips by 1.618. This is one of the Fibonacci ratios, okay? And in this example here that I've used, which is given on our presentation, 50 pips, for example. So it's 100. That's the stop loss. That's the amount that you're risking divided by 50 pips multiplied by 10, get 0.2 lots. This has to be a big account. Of course, before you risk $100, you have to have a big account, right? Then you get 0.2 lots. Okay. So if you want to get the amount of to estimate the amount of profits as well, you might have to consider multiplying the stop loss pips by 1.618. This is going to lead to around 1 is to 1 and 3/4 risk reward, right? So if you multiply 50 pips by that one, it will give you 81 pips profit. So if this is your trade which you're entering here, and this is where you entered, maybe you bought at that point, between the entry and the stop loss level, that is 50 pips, right? 50 pips. And between your entry all the way to your profits, right? Your take profit, then you're giving it 81 pips. If you look at this one, it's not, for 1:2 is supposed to be 50 pips to 100, right? But this one is around 1:, maybe 1 3/4 risk reward ratio. So you can try to follow up this one and see whether it can help you as well in your trading, and it should help you, right? So position sizing is very important, right? For accounts between $0 to $100, just maintain a very small lot size. A 0.01 should work for you. If the account go on growing, then you can think of increasing it, right? So whenever you have, for example, there we had 0.008, sometimes you want to round it off so that you can get a 0.01 lot size. So long as it gives you that amount, keep to it, stick to it. That is what disciplined trading is. Position sizing, that's number 2. Aspect number 3, risk to reward ratio. I've mentioned it's slightly risk to reward ratio. So what is risk? What is reward? Risk is the amount which you'll be losing if your order hits the stop loss. Look at the example here. The example A. You're on a downtrend, right? You get a very nice entry at the rejection of maybe a candlestick or around the trend line there. Then you enter your trade. Before you enter, you have the stop loss and you have your target. So the amount of money which you lose when your order hits the stop loss, that is your risk. That's the amount of money you're risking in the market, right? And the amount of money which you're looking for and to get whatever you're targeting as profit is your reward. So when you talk about risk to reward, is the amount of money which you're risking in the market in comparison to what you're looking for and to get. So risk reward is the total risk over the total reward. So taking a reasonable risk to reward ratio negates greed in trading. Sometimes as a trader, you may be expecting that yes, of course, you've got a very nice trend. This trade is trending downwards, moving down that way. Instead of collecting your profits, that's where you were expecting the price to go. You still want to continue getting those profits, right? So you don't know where to close or how to manage that trade, right? You need to know how much you're targeting, all right? So that you don't have to wait all the way up until the price hits or attains a nice level that you could have taken your profits, all right? Maybe you could have been at that point where you could have taken your profits here and leave it to go and test the trend line again, right? So you need to know the right level to target. You have to understand your targets well. That is your reward. Risk, you should not allow your, if for example you're losing, you should not allow your trade to keep on flowing along and taking out your money. You need to know where to stop it. That is at the stop loss level. So whatever you lose at the stop loss level, that is your risk. So in every single of your trade, how is the proportion of the amount of money which you're risking at the stop loss level and what you're targeting, yeah, at the profit level? And that is very important. It helps you to manage your risk, right? And to avoid targeting unreasonable profits when you know it's not easy coming, especially in Forex, not easy coming. You have a $100 account and you want to, that's what again pushes traders to start putting big lots. Now, you need to target high reward to risk, okay, for higher chances to break even in the future. The thing is, for example, if you're entering a trade and you're taking a very big stop level, you put your stop loss there, but then you're taking a very small take profit. At the end of it all, one day it will go and take up the stop loss. It will take a bigger amount than you've been getting 3 or 4 times in your trading. So you've been taking, for example, if you have you for every $1 you risk, for example, you're targeting $2. So if you win 5 times, for example, you get $10. If you lose 5 times here, you just lose $5. So if you compare $5 and $10, then of course you break even. Minus 5 and plus 10, that is a break even. What if you are targeting maybe at a risk reward of less than 1:1, maybe 1:0.5? For the people who want to take, for the people who don't understand the best places to put a stop loss or a take profit, and now you want to avoid using a stop loss, or you have the stop loss too far away, and then you have your take profit quite near. So what will happen is that, for example, let's take an example, 5 trades like we've done here. So if you lose 5 trades in this case, you'll have lost $5, right? If you win 5 trades, you'll have got 2.5. So overall, minus 5 plus 5, you're negative. So the best thing is, the best advice is have something higher than 1:1. Maybe 1:1 or 1:1, right? And again, on the upper side, if you can maintain a 1:2, then well and good, right? Because again, if you start targeting some bigger rewards, right, it becomes difficult. Sometimes not all trades will achieve those levels, because that's when it exposes you. Unless you have practice and know how to manage your orders, it becomes difficult to achieve those levels. So when you're starting up, for example, consider smaller risk, smaller risk, and a little bit higher reward not too high. Now, how do you calculate your total risk? Total risk is equal to the pip value multiplied by the entry price minus the stop loss price. Entry price, I explained that one on when we were looking at the chart. So total reward is equal to the pip value multiplied by the entry price minus the take profit price. It's simply like the number of pips. Pips, the profit pips, and the loss pips. That's the amount of money which you're getting or losing. How much of money are you risking? So let's say, for example, with a risk reward of 1:1, it means for every $2 you're risking, then you're looking for one to get $2. If you have 1:1.5 risk reward, it means for every $2 you're risking, yeah, you're looking for one to get, no, this is wrong. Looking for one to get $3, not 1.5, right? Looking for one to get $3. Okay, that is 1 to 1.5, not 1.5, $3. Mistake there. If you are risking $5, for example, for the people who are taking, and this is the amount of money which you're risking per trade. That is the risk per trade. All right. So if you're risking $5, for example, you're risking losing $5. If you have 1:2 risk reward ratio, then it means you're targeting double whatever you're risking. It should be $10 as profit, right? If you're risking $2, you're looking for 1:5. So 5 times reward, you get $10. This is not easy coming. You need to have got a very nice trend and you're riding it very well and you're really good in it. Most of the times, and I will repeat several times, even when I'm in training or in class with people who are learning how to trade. Sometimes it's not all about riding a very big trend. Sometimes it's all about knowing how much are you targeting, and then you make it a routine and you be consistent in getting whatever you are targeting. So risk reward ratio is very important. Don't have a risk reward ratio of less than 1:1. Less than that, it's not good. Sometimes I would, if you have 1:2, 1:1.5, yeah, 1:1.5, 1:2, maybe 1:3, right? It's working for you. Otherwise, if you can get even something bigger than that, well and good, but sometimes you need to know the best levels to take your profits, right? And get satisfied with what you have. Don't allow yourself to be driven by greed, because risk reward, a reasonable risk reward, helps you to avoid greedy trading. So point number 3, risk to reward. My recommendation, as from 1:1 risk reward ratio, 1:1.5, 1:2. That one should be enough. If you get anything bigger than that, well and good, go get it, right? But whenever you get 1:1.5, 1:2, you are in profits already. Maybe you can consider protecting your profits using a trailing stop, but it's something that you should consider taking. Yeah, trailing stop to realize the reward. That's point number 3, risk to the reward. I talked about 5 points. Another very important thing is leverage. So what is leverage? It helps you to trade with a small capital. You trade more using a small capital. So if, for example, you are trading an asset which is worth $1,000, for example, and this should be a very easy example to understand, because remember 0.01, this is a micro lot, this is equal to 1,000 units. 1,000 units, for example, 1,000 euros. You're trading with Euro USD. Should be 1,000 euros, for example. If that's what you wanted to trade with, right? Let me talk of something which has got a USD. Just for example, it's USD JPY. Just for easy calculation, if it's USD, for example, 1,000 USD, that's what you would hold a position on. Maybe it's for a USD JPY, right? So when you have margin and when you don't have a margin, when you have a margin, when you have a leverage, you're trading at a margin, which means you're required to just use a percentage of your capital to open that position. So in this case, and when you're trading with the smallest lot size, which is a micro lot at 0.01, it means if you have a 0.01 position with the USD JPY, for example, if you have a margin of a leverage of 1:400, just the normal the default that we give you at Fxpesa, it means that you're required to have only a 0.25%, 0.25% of this 1,000 for you to place that trade. So you can imagine the whole of 99.75 you've just been given, right? So you're just taking a small percentage of your money to hold a position worth $1,000, but when you're getting profits, this is where it gets tricky. When you're getting profits or losses, you get it in terms of the movements of the actual volume that you've traded. So the loss that someone who had held $1,000 in actual or an asset or worth $1,000 physically is how much you'll be able to make as a loss or a profit. That's where it gets tricky, right? Because you're taking a leverage, right? You're trading at a margin. Yes, you require a small amount of money, but you're going to realize profits or losses, right, in the actual movements or the actual profits that someone who did not take any leverage is making. That's why it gets tricky. That's why it gets sweet as well. Because when you make profits of the actual whole value of the asset that you're holding. But leverage makes trading interesting and makes it possible for everyone to trade, because were it not for the leverage, then it means that most of us, or I don't know, I don't know who you are, I don't know how much you have, but most of us will trade a small amount of capital. Okay, it means you need to have tens of thousands of money of US dollars to be able to trade on these assets if there was no leverage. But because of leverage, thanks to that, we're able to trade with a small amount of money. But remember, what happens is that for every $1, in this case, for every $1 you have, you can be able to trade something worth $400. That's what it means. Or if you're looking at the asset value, it's just a 0.25%. That one goes on for every leverage. If you have got 1:200, so if you reduce the leverage, then of course the amount being given to you reduces. All right. In this case, it means for every $1, then you're able to trade a maximum of 200, right, or 200 times. This is going to be like you're required to have like a 0.5%. So here you can see that the amount of money you're required to have as you reduce the leverage is more. So it's also working to your disadvantage of trading a smaller capital. Yes, it's reducing the risk, but also it increases the amount of money you're required to have. In this case, you're required to have, let's say for example, for this type of a trade, you're required to have like $2.5, right? The required margin. That's the required margin, right? For a 1:200 leverage, then you're going to have $5. And as you keep on reducing, it means you're going to be required to have more money, right? But you need to know how to balance all this. In the event that you're using this leverage, because it enables you to trade whenever you've opened your account at Fxpesa and you've not taken time to change it, remember it's at 1:400. Although we have various financial instruments that have got different leverage, right? But that's the default for currencies. So you need to decide. You either want to deposit more money into your account and you can reduce the leverage. But if you're the trader that you want to start the markets and test the markets with $10, $50, $100, then you need this leverage, because you will have to hold, you will need, because of the positions you can take advantage of, right? So you can't escape from that. You have to work on it. All right. For the traders who don't want to hear depositing a large amount of money in your account, then of course you have to put up with a big leverage, because else you won't be able to trade, because you can see the required margin, right? Otherwise, if you're able to deposit a large amount of money in your account, you can get along and reduce the leverage. It will reduce your risk quite a lot. So let's take an example. If your leverage 1:100, I think I've explained this one, but I can repeat. With an account of $100, you can place a trade worth up to 1,000, right? Should be 10,000, right? Should be 10,000. 1:100, you can place a trade worth up to 10,000, right? If you had a $10 account, this is a case where, for example, if you had a $10 account, you would be able to trade like 10,000, right? If you have 1:400, right, then you'll be able to with a $10 account. It means that money is maximized up to like 40,000, right? So that's how it goes. But if the market moves in your favor, you benefit from the actual volume of the trade taken. But if it moves against you, then the loss is in terms of the actual volume of trade taken. So it's like a double-edged sword. You have to know how to use it. I always give an example of a knife. You need a very sharp knife at your kitchen. A very sharp knife at your kitchen. And if you make a mistake and it's so sharp, you cut your finger, you feel a lot of pain. But you go and dump the knife, you don't use it again in your kitchen. What do you cut the vegetables with? So it's all about knowing you have a very sharp knife. You have to be careful when you're using it because it helps you prepare a very delicious meal, for example. Just an example I'm giving out there. So leverage, know how to use it well. If you know you're able to deposit a large amount of money, you can reduce the leverage to low levels. It's advisable because it's lower risk, right? But if you've got a very small amount of money, I mean, you can reduce it, but remember, you have to put up with a higher required margin or margin requirement. So again, leverage is something very important, right? For us, we offer 1:400 leverage. That is considerably moderate, okay? Because outside there, you will find brokers who will offer you 1:1000. That one is a killer leverage, right? It's quite big. You might not want to try out something like that. 1:400, still it's high, but it's considerably moderate. You can want to reduce it, maybe. You always can reduce it, right? And it will help you reduce the risk that you're exposing yourself outside there. But you need to consider how much you're having in your account as well, because of the required margin. Those are things that you have to know how to balance. So number 4, leverage, very important. Overexposure, that's number 5. You see, we have got so many currencies. We've got euro paired against any various currencies. You have got euro crosses, let's say euro Japanese yen, and you have euro USD, yeah, and maybe, for example, you have so many others. I just want to take a few examples: USD, JPY, and maybe euro USD, or GBP, pound, and Canadian dollar. So when we talk about exposure is where you're taking multiple positions on the common currency. So you get a good opportunity, you buy euro USD, or maybe it's euro JPY, you buy euro JPY. You find a very nice opportunity with euro USD, again you buy. So I've got 2 trades, right? 2 different pairs giving you 2 trades. But you see here, it's like you traded on euro twice. If you bought euro at 0.01 or 0.02 lots of euro Japanese yen, another one 0.02 euro USD. The thing is that, yes, you've distributed a 0.04 lots of trade euro for euro on 2 pairs, which are almost similar, even if you have differences on the Japanese yen here, right, and on the quote currencies, but this is almost the same. You've bought euro twice. So whenever you find yourself, you're opening positions on the same currency pair, either as a quote or as a base, then you're overexposing yourself, or maybe you're even placing opposite trades, right, which are canceling each other. So just be careful. For example, when you open a buy position on Australian dollar USD, Aussie USD, New Zealand USD, essentially it's like having same trades, because you've bought Australian dollar, you've bought the New Zealand dollar, yes, but you have sold USD in both cases. So it's like splitting two trades, splitting one trade into 2. That's, if you want to use that one positively, think, for example, in the case where you're not risking more than $10 in a trade, in a single trade, but maybe you want to distribute it. You want to try to, let me say distribute, because it doesn't qualify to be diversifying. I wanted to use the word diversify, but it doesn't qualify to be diversifying. It's the same pair. So if you have got $10 to risk for every single trade, maybe you might want to distribute it to half, and one of the trades will take $5, the other will take another $5, right? If it was maybe $4, then you want to distribute it maybe to one trade to take 2, the other to take 2, because you know that it's just the same currency. Instead of having a $10 risk on Euro JPY, maybe you won't go and take a $5 on Euro JPY and then another one on Euro USD. That case would apply. So that's when it becomes part of your trading strategy. It's either in your trading strategy, that's why you're doing it. But if it's not in your trading strategy, and in every single trade you're risking that $10, all right, and that one is going to, like different trades, that you're overexposing yourself twice. If things go wrong with the euro or the USD, in this case, you'll be losing a lot. So try to like diversify. You have a euro USD, go take a completely different pair. So if euro JPY and euro USD is giving you a nice trade, choose one. Or if you still want to trade on all of them, then distribute your positions. All right, that's number one. So overexposure. Another thing, so if you wanted to take those trades, check out and distribute on various currency pairs which are not related. You have got euro USD here. Go to something like pound. Okay, if you've got euro Japanese yen, you can go for something different, maybe Australian dollar and Canadian dollar. Check out outside there, you can see correlation heat map. You can see how currencies are correlated. So make sure you understand the correlation of currencies. Remember, we said that when you're trading in the markets, as you're developing a strategy, number one, you need to understand which financial instrument you're trading on. For example, if you trade on oil, you need to know that oil is directly correlated with Canadian dollar. If you're trading on gold, you need to know that gold is directly correlated with Australian dollar. Then you need to understand the movements, for example, right? So before you hold a position on Canadian dollar and you still have another position on gold, or sorry, Canadian dollar and you have another position on oil, then you need to understand the correlation to avoid overexposing yourself. So be careful. You might believe that you're diversifying your position, but you're exposing yourself to bigger risk. Another approach is for, you have guys who always keep on adding to a position, right? You have a position that you believe it has been an uptrend, and you buy at that point, for example, and if it keeps on dropping, you believe this is a 0.1, for example, 0.01, you buy at that point, keeps going lower, but you still believe, most of the times people are using the overbought levels for the RSI. You believe it's at overbought and it's just about to rise. You're at 30, right? You take a position, it's at overbought, still going lower, right? You want to add something else, 0.01 to recoup, still keeping going lower. That's not right, right? That's not right, unless it's part of your trading strategy. Yes, of course, the overbought can work, oversold can work, but adding to the position, this is what most of the times leads to traders adding to a position. If you're losing, you should have had a stop loss, which should have got you out of that trade, so that you look for another position, for example, to enter. So be careful about overexposing yourself in the market. Make sure you understand the correlation in the market as well. So that's number 5. So else, what I'm going to mention is like bonus to you, your growth plan. What is your growth plan? For example, when you're trading that account, what is your approach to growing it? Because you're putting your money there with an expectation to make more. So what's your plan? And people want maybe to increase the lot size. So you can work on it around on the amount of risk that you're taking for every trade, or check out on the pips that you're increasing for every trade. So we've got fixed fractional money management approach, right? It means that you're taking constant risk irrespective of the account size, whether you have got $100 or you have grown it to $10,000, sorry, $1,000, you just maintain a 2%. So what it means is that, for example, if each trade is 2% per, if you're risking 2% per trade, then it means 2% risk of $100 is $2 risk, right? 2% of 150, then it's going to be $3 risk, $3 risk. If your money grows to 200, still you're maintaining 2% risk. All right. So you maintain that constant risk for your account. Of course, you know how much you're targeting. So the position size grows as account grows, because 2% of 150 is going to give you, if you are using maybe, for example, 1:2 risk reward ratio. So if you're risking $2, you'll be targeting 4. If you're risking 2, you'll be targeting 4. If you're risking $3, you'll be targeting 6. If you're risking $4, you'll be targeting 8. So you see that your position size grows as account grows, but the risk of big drawdown in the future is there, because if your money grows, then of course you find yourself with calculating at 2% of 1,000. Yeah, if you do a 2% of 1,000, it's going to give you like 20. If you lose 20, it's a big drawdown. So you have to bear with that as well. There's nothing which is like 100% proof. Anything has got its own weaknesses all along. Another approach is fixed ratio money management. So you maintain a fixed lot size based on profit or how much you've grown your account. So this is quite simple. If, for example, you have got $100 to 200, you trade with a 0.1 lot size. If, for example, you increase your account, you're able to grow it from 200 to 300. All along here, you can't use anything bigger than 0.02. Again, that's something you assign yourself based on how you want to grow your account, and based on your trading, and based on your risk as well. In as much as you're using these lot sizes, remember we've seen how you can estimate the amount of lot size you can use. All right. In as much as you're using these lot sizes, make sure it's within the few aspects we checked out there. So have a growth plan, choose a growth plan, and know its consequences, and understand how to work around it. So, and that's what I had for you. So maybe if you can recap a little bit on the 5 things you need to get hold of. Risk per trade, that's number 1. And along that one, you're looking at risk per trade, every single trade. How much risk are you taking maybe in a single trading day, and how much drawdown? That's what you want to add there. So risk per trade, position sizing, how many lots are you using for your trades? That's very important. You might want to distribute it. If you have to trade on 2 similar currencies, you can distribute it, for example, maintaining the same position size, the same amount of risk that you're taking. So position size is very important. Yeah, if you are taking a $6 risk, for example, maybe here you are going to use maybe a 0.02 lot size, right? You might want to distribute this to 2 trades. Maybe it's Euro, USD, Euro against USD. You're seeing a very nice trade there, and then you have another one like Euro against maybe Euro GBP, and you still want to trade on all of them. Instead of risking 6 trades for one single of these, then you can take Euro USD, $3. So you're distributing it, and for this one you have to take a lot size of 0.1, and for the other one another $3, right? And then 0.01. So instead of having one trade of Euro USD, where you'll be waiting, you're exposing yourself this much to $6, you might want to split the position sizes 0.01 to 2 different currencies, right? And it's trying to diversify, yes, but there's a lot of similarity in this, a lot of correlation. But if you understand it, you can flow with it a little bit better. So number 2, position sizing. Number 3, risk to reward ratio. Don't be greedy. Target something that's reasonable. Number 3, leverage. Consider how much you're depositing into your account, and whether if you reduce the leverage it won't hurt you, or what will happen in that case. Leverage is very important. Don't overexpose yourself. And correlation. Choice of growth plan. Obvious, make sure you have a growth plan. If you don't have one, then you're blindly trading, because you're in that market for you to make money. Make sure you have at least an idea of how you want to grow your money. Instead of finding yourself today, you're putting a lot size of 0.01. Next day, you're trying a 0.1. Remember the example I gave about using a bigger lot and how you calculate. And ladies and gentlemen, that's what I had for you. Unless you have questions, drop them there. Let me check out a few might be having. I will take a few minutes to answer to these or respond to your questions. You want a recorded video? We'll work on it and see whether we can deliver it. So what leverage should you use for $100 account? Duncan, that account is small. You might want to maintain the 1:400, right? Or you can as well reduce it to 1:200, right? That's your choice. But I would recommend, if you've got a small account, just use 1:400. But you can always reduce it, right? If you use a high leverage of like 1:400, use a small lot size and stick to it. How you set the ratio? Sometimes you set the ratio depending on the setup in the market, right? That's what helps you to set the ratio. So what you look at if you're setting the ratio, for example, looking at the chart there, the same example I was giving, if you try and compare and see where you're looking forward to enter your trade, if you're targeting this point here at the top, hope you can see my screen. I see the view is interrupted. Well, if for example you check out where you're targeting for the stop loss, where you're targeting for the take profit, that's what gives you the ratio. So sometimes you might realize that you might be targeting a smaller profit. When you check the best place for you to put a stop loss, it's down here, of course, at the moving average. This is a distance of like 50 pips, 54 pips. But if you look at what you're targeting, for example, it's something like 30, 33 pips. That's not enough. You have a bigger risk. If you take the stop loss at the best point, you have a bigger risk than the profit. So you might have to ignore some of these positions if they show up in such a manner, right? Something else, David is asking, traders sell a pair, traders not go their way, they buy the same pair without exiting the one. If you see the one which is profitable, they exit. So that one is like gambling. So you don't know where the price is going. It's like now you go to the chart and you buy and sell. That's like gambling. Well, if you have a strategy working that way, then well and good, because there are people who will build strategies based on that. But make sure it's your strategy you have. So if let's say, for example, you've entered a 0.01 trade, right? And you buy 0.01, you sell 0.01 of the same trade. So if one is making profit, the other one is making loss, then that's a zero-sum game, because you lose 50, you are minus 50 and plus 50. So even if you close the one which you are plus 50, you still have the minus 50, getting some, of course, getting some negatives on your account, right? Unless if you have to keep it up until it gets some profit. But again, that's not good. That's why you have the stop loss and take profit. That's why you have to form your own trading strategy, so that you know whether you should buy or sell. You should make a decision, unless you are also hedging, right? Hedging is there, but most of the times for hedging, you need to be really good in it. So you have to practice and make it part of your trading strategy. Target profit for 200 account, again, per day, it depends. If you're good in trading with a $200 account, you can make more than $10 in a day, right? Or even more than that, but it depends with your trading strategy, John, right? It depends with how good you are in getting good trades. But if you're starting up with a $200 account, don't risk too much. Stick to a small lot size. Make sure you get hold of a trading strategy. Indices, are they leverages? Yes, of course, even indices have got a leverage, but they are different. You might want to go to fxpesa.com and check out on various financial instruments on the products that we have. You'll find a lot of information on the leverage offered for every single financial instrument, and the maximum amount of contracts you can trade. You can always find that information there. So Michelle, go to fxpesa.com, and on the left side on the menu, check out on products. Look out for all of them. You can even find information for stocks and all those financial instruments. You can find all that. Adding buys or sells on a drawdown, I won't advise on that, right? I won't advise on that, because it's always good to cut down your losses whenever the trade goes against you, right? Unless if you're hedging, yes, of course you can hedge, but it's a little bit more complicated. Before you see, hedging, it's not that the people who hedge like it. You don't hedge because you like it. You hedge because you're protecting yourself. So why don't you protect yourself first on the stop loss level, instead of having to place another trade? It works in the market, hedging works in the market, but you have to practice. And sometimes you need to learn the correlation of those currencies to learn which one is the best to hedge the other one with, right? But I would advise learn how to use the stop loss, yeah, to avoid yourself placing multiple trades, because at the end of it all, you might hedge a position, and if you are losing, and somewhere in between, for example, you buy at a high price. Let me give you an example. I find this a little bit interesting, right? You buy, this is a trend, so you have a trend here, right? You buy at this point, right? Maybe you buy at 0.01 or 0.02, right? It goes back again, right? At this point here, you sell, right? So you buy here, at this point here, for example, you sell. What happens if it starts going up again? So you are losing here, yes, of course. If it starts going up again, you as well in losses. So sometimes you get caught up in all these challenges. If your money was a little bit, and most of the times you see that traders would want to place a bigger lot when they're putting an opposite trade. So what happens if the trade is getting back again? You might be even falling to bigger losses. You can have your account easily stopped out. All right. So I would advise, know how to use the stop losses, know them so well that you don't have even to hedge, because hedging is not that you want it. It's mostly important in stocks, because in one way or another, a stock has to rise. Okay, but I would advise not to use it. Maybe remember, there are so many ways you can trade the market. You can use the hedging strategy, but make sure you know it so well. But for me, I would advise you to know where to put your stop loss and take profit. Scalping, a good idea? Yes, a very good idea if you've taken time to understand it. All right. There are different ways that you trade. We have day traders. You have got day traders. Still, we have the scalpers. Scalpers are day traders as well. You have got scalpers. They are day traders. That is, if you're opening your positions and closing them within 24 hours, you don't leave them to go beyond 12, right? 12 a.m. at midnight. As a day trader. Then you have a swing trader. You're holding your positions for several days, maybe 2 to 3 days. Beyond 1 week, you're a position trader. So there's no problem if you're a scalper and you're making profits. The reason why you're in these buckets is for you to make profits. So yes, it's a good idea, but make sure you understand it very well. So in the event that you buy, for example, and there's always drawdown at times, what about adding buys to get additional profits when it goes back? You can do that, but how sure are you it will go back? It depends, right? It depends. So, ladies and gentlemen, thank you so much for attending, and I'm happy to see you, happy to hear. I've not seen you, right? I'm happy to see your questions, right? And interact with you through your questions. Keep getting better. Make sure to use those few pointers there in your risk management. Remember, risk management is very important, because if you lose your money, you've got nothing to trade with, right? So you safeguard your money and make sure keep on getting better. Thank you so much, and up until next time, bye for now.